hashtag ITI. As a research analyst here at ITIF, will be presenting your remarks about the report we released. So, Alan, turn it over to you.
Hi, thank you for joining us all today. I hope you enjoy the report. So, the financial services sector has a long history of using IT for process innovation. If you go back to the 1950s, we had credit cards that eased the burden of cash in people's pockets. 1960s saw ATMs, self-service ATMs help allocate tellers. The 70s and 80s saw computers being incorporated into stock exchanges and online banking, and then in the 2000s we saw internet banking and then mobile banking. In fact, labor productivity has increased 153% in commercial banking from 1987 to 2015. So what's different now? Financial services are potentially at its Skype moment. What do I mean by that? Well, when you look at telephone companies, traditional telephone companies, they used to be very expensive and intermediary driven, where local, long distance, and international companies were expensive, and they would use technology and a lot of employee costs to direct phone calls. And then the internet happened, and people realized that voice could be just another set of ones and zeros put over a network. This lowered costs, this removed intermediaries, and we have the system that we have today. We're potentially at a similar inflection point with financial services, where expensive and complex networks are giving way to cheaper general purpose networks. This is the radical potential of fintech, to disintermediate financial services. And software is eating everything. And as a result, financial services are global, scalable, and more inclusive. I mean, look at Facebook. This year, they incorporated payments into their Messenger app, and they were able to add 1.7 billion monthly users, provide them with a payment service instantly overnight. So what is fintech? Fintech is a somewhat nebulous term that refers to a set of businesses using IT innovation to provide, to improve upon financial services. This definition can be somewhat hard to parse out with because it actually doesn't refer to financial technology, but rather the businesses incorporating that. Financial technology includes things such as artificial intelligence, which is used across sectors. So in this report, we highlight four primary categories for fintech. We got payments and transfers, personal finance, alternative finance, and insurance. There's many more. We were totally holistic in the report, but these ones will suffice for the discussion today. Now, because of the broad definition of fintech, we really wanted to look at the different productivity of each of the applications of and the new financial services. So we separated it between what applications were simply enhancing user experience and which ones have more of a significant productivity gain. I'm going to highlight three of the best examples that we came up with today. The first one is digital remittances. So a remittance is when someone, an expatriate from one country, sends money to their home country. Say a Costa Rican immigrant in the United States sends money home to Costa Rica. In the traditional service, this money flow would go through multiple different intermediaries, each of which would extract a small portion, and it was driven by, it would increase costs through these number of intermediaries. And with digital remittance services, such as TransferWise, we've completely foregone that process. In fact, some of these services are able to reduce the costs of digital remittances by 45%. The second one I'll highlight is robo-advisors, which are these automated financial and investment tools that use algorithms to manage people's investments. They usually focus on low risk and low cost investments. And a couple examples of those are Acorns, Betterment, SigFig, and Acorns, Betterment, and SigFig. And what this is able to do is it removes traditional banking intermediaries, lower costs, and provide better services to more people. So the third one that I'll highlight is peer-to-peer lenders. What a peer-to-peer lender is peer-to-peer lenders are basically a borrower is able to get a loan from either an individual lender or multiple lenders over a service. So say I want to get a loan. I go to this peer-to-peer lender and I ask, they give me a risk score. I then get a loan from people who are willing to give to me. I get a lower rate on my loan. The lender gets a higher return of service than they would, say, their savings account or bank account, and the alternative lending club, gets a small portion. These are not geographically close to one another, and it removes traditional intermediaries, reducing the costs in the process. So when we look across all of these examples, we see fast, innovative technological solutions that are breaking silos across borders. So how can policymakers maximize innovations in financial services while upholding consumer protections and market stability? Well, if you turn to page 31 in the report, there are 10 policy principles that we outline for how to accomplish this. I'm going to briefly run through all 10 of them now. The first one is support fintech transformation. What this means is governments can help actively support adoption of fintech by adopting it themselves. For example, a state could enable universal mobile payment options for paying so that people can pay the taxes or buy a hunting license online all through a single convenient platform. The second one is work to ensure that regulations encourage innovation in financial services. What this means is that regulators should set priorities for regulation and draw clear boundaries based on the risk of any particular fintech application. The goal of this should be to decide what is in scope and out of scope, and to not necessarily target the underlying technology, but rather the services running over it. The third policy principle is to remove duplicative regulations in financial services. Fintech companies face a barrage of different regulations from a number of different regulators, many of which overlap. There are 40 plus anti-money laundering federal agencies that focus on that in the United States. Where there is overlap, policymakers should strive to coordinate and centralize these activities to streamline the process and reduce regulatory burden on fintech companies. The fourth one is to regulate fintech at a national level. So it's pretty straightforward, but from the onset, many of these financial companies are global companies, and policymakers should not try to bog down innovative financial services with mismatching regulations in every jurisdiction in which they operate. I'm sure we'll discuss that on the panel later. Number 5 is to use regulatory enforcement actions to incentivize companies to protect consumers rather than themselves. There will always be times where regulators need to take action, but to ensure continued innovation, it is important that regulators aim at companies that are breaking the spirit of the law rather than just the letter of the law. Number 6 is to create tech-neutral rules. So these type of rules neither favor nor disadvantage any particular technology to create a level playing field for all innovation. Number 7 is to encourage a level playing field between incumbents and new entrants. That's pretty straightforward. Number 8 is to promote cybersecurity in fintech. Now, what's important about this one is financial services companies are beset on all sides by a barrage of different malicious actors trying to steal money or create fraud or just create mischief. And to ensure that financial companies are creating secure services, governments should create incentives to better cybersecurity in these products through purchasing, regulation, or oversight. Number 9 is to support standards development and financial data interoperability. One of the big problems with fintech companies trying to scale their services globally is that they run into different mismatching definitions and data standards as they go international, and national governments should engage with financial services industry to set standards. Number 10 is to promote international harmonization in laws affecting the financial services sector. This means to harmonize laws affecting this financial services sector, such as routing transactions, transparency, anti-money laundering, and to actively push back against barriers to data flows. So the financial services sector stands at an inflection point. And the question remains, how can policymakers adequately capture the benefits of fintech while still protecting customers. This report outlines a number of principles to do just that. I look forward to the discussion. Thank you.
Thank you, Alan. So we're going to turn to the panel. Everyone's bio is online, so I'm just going to briefly introduce everyone. Starting on my left, Bobby Thompson is head of U.S. Government Relations at Visa. Margaret Liu is the Senior Vice President and Deputy General Counsel at the Conference of State Bank Supervisors. And Brian Peters is the Executive Director of Financial Innovation Now, an alliance of leading tech companies. Helen Wong is an attorney at the Federal Trade Commission with the Division of Financial Practices. In particular, she's been the lead attorney on a number of the FTC's cases on Bitcoin and the FTC's first crowdfunding case. And Sam Kosig is head of government relations, community banking, and cabbage and online lender. So thanks to all of you for being here today. To start it off, I just wanted to kind of open it up to the panel, and we can just go down the row. On any reactions, all of you had a chance to preview the report and, of course, hear Helen's remarks here today. Any reactions on, especially I think the principles for how policymakers should be thinking about that, either from your own perspective from a company or, obviously from the government perspective of how you're thinking about these issues as well. So Bobby, why don't we start with you?
Sure. Well, good morning, everyone, and thanks for convening the panel today. And just wanted to say we appreciate all the work that ITIF has done in looking at innovation, looking at how regulation can promote innovation. And I think there's a lot in here that's really worth thinking and talking about in terms of really promoting policies that encourage innovation and partnerships. One thing I just wanted to mention as we think about this at Visa, there's just enormous change that's happening in the marketplace. And so with any regulatory discussion, you have to think about what are the principles that can take this forward, because it's really tough to go back and change regulatory policies frequently. And so if you have a good framework that allows innovation to occur, you're going to be in a better place. And just within the payments world, which is what we focus on, Visa is roughly 55 or so years old, and we have about 3 billion Visa cards in circulation globally. But when you think about the technology transformation, there are about 7 billion mobile phones globally, all of which can be made to accept payment and make payment. And that's a big number. And when you think about the Internet of Things, there's some estimates that say there are about 20 billion connected devices. And so this is a payment ring that Visa did for the Olympics, with athletes to allow them to pay sort of whatever they wanted on the go because they weren't able to sort of carry cash. But all these things are different in terms of technology, but they share similar characteristics. And I think that's going to be one of the challenges on the regulatory front is how do you have a consistent set of framework regardless of the service that's provided. So anyway, just kudos to ITF for really driving the conversation today.
Margaret.
Thanks. Maybe I'll take just a moment to explain who the Conference of State Bank Supervisors is, because we are not necessarily as well known a name as some of my fellow panelists. CSBS is the Washington policy organization representing state banking and financial services regulators. We are their membership association, so these are the individual financial regulators in all the 50 states, DC and the territories. In the setting of fintech, often referred to as the patchwork quilt. There are a lot of other adjectives. The most elegant one I heard was a lattice work recently of varying state standards. But what CSBS does is we bring our members together to interact with the policy space here in Washington, federal regulators, federal executive agencies, and Congress. And fintech is certainly something that our members have been thinking about for a long time. They've been thinking about it before the term actually became really popular, and it's something certainly that is on everybody's mind in Washington in terms of thinking about the right policy structures, regulation, and a lot of other issues. But state regulators don't necessarily have the luxury of just sitting back and thinking about policies. They're out there licensing and regulating these entities right now. Because when you think about the nature of the technology is really breathtaking in terms of the changes and the innovations. But we're talking about incredible new delivery mechanisms, new uses of data and technology. But one of the things that state regulators focus on is the consumer experience and consumer protection. And when you think about consumer protection, while the tools are many and they continue to change, and the consumer benefit of these new delivery mechanisms is undoubted, the activity in a lot of ways is still the same. This gets to a few of the principles. that are in here. You know, regulators are tech neutral. They're not looking at regulating a certain type of technology. And so when I look through these principles, there are a lot of things that I think speak to the states. However, I think that one of the things that's important to think about and remember is that from the consumer standpoint, is it really that different, right? You're talking about a few different types of activities: the extension of credit, investment advising, holding, moving, and exchanging money or something of value. And so regulators are looking at the activities. They're trying to understand the new delivery mechanisms, and a report like this is great in terms of laying out in a concise fashion some of the business models and delivery mechanisms and companies that we're talking about. And we'll get into later on some of the more details around different regulatory approaches.
Thank you. All right. My name is Brian Peters. I'm the Executive Director of Financial Innovation Now, and I think Daniel mentioned it, but we're comprised of 5 leading technology companies: Apple, Amazon, Google, Intuit, and PayPal. We came together, I would say, just over a year ago because we saw this technological transformation happening in the marketplace and realized that policymakers were going to start to engage. And now, a year later, that process is, I think, full on. It has begun in earnest. I would say we're upwards of 10 federal regulators are doing something actively, at least holding a forum, in some cases actually doing regulatory policy on this. Up on the Hill, there are new bills being introduced at the clip of about 2 or 3 per month at this point. So we're engaged primarily to educate and talk about a lot of this and advocate, I'd say primarily for policies that will enable more of this transformation. We believe it's good for consumers because it will make financial services more accessible. It'll make it safer and more secure and ultimately more affordable. I'd say that the report, I think, is great in the sense that it, I think, adequately reflects the context of what's going on out there. This is truly disruptive. It does have that potential, and I think we appreciate that. Some of the points with respect to data, specifically principle number 9, I think is spot on. A lot of the innovation happening, whether it's from one of our companies or whether it's from a traditional financial institution, really depends on using data, an individual or a small business's financial information in novel and innovative ways to deliver financial services that they previously could not get so easily or at the right rate, an affordable rate. So that's, I think, something that I'm looking forward to talking about. I would finally say that because I'm flanked by kind of our regulatory friends, we think there is a positive role that regulators play in this space. Our companies all bring services to the market that are fully compliant with the large set of financial services laws and regulations at the federal and at the local level. So we do our best to stay ahead of that and to engage in this process. And I think here at the federal level, we're happy that Congress and that federal regulators are looking seriously at how to promote more of this.
Hi everyone, my name is Helen Wong. I'm an attorney at the Federal Trade Commission. The FTC is the nation's primary consumer protection agency. Let me just start with saying that all the views expressed today are my own and do not necessarily represent that of any commissioner or the FTC. That being said, at the FTC, we're very supportive of fintech. We think that these new technologies give consumers a lot of new options. It empowers them to spend, store, and share money in ways that they maybe couldn't do before. But at the same time, I want to echo a bit of what Margaret said. A lot of what they're doing is the same. So whether it's a fintech product or a traditional financial product, basic consumer protection principles always apply. And by basic, I just mean when you make promises to consumers, keep them. Don't make deceptive representations and make sure you have adequate disclosures. And to that point, I think that a lot of these principles do cover that. And I know we'll talk a bit more about the actual regulation itself. So I'll wait for our discussion.
Good morning, everyone. My name is Sam Taussig. I'm head of government relations and community banking and token millennial at Cabbage. Cabbage is an online small business lender, a fintech company that connects a small business checking account data and other alternative data such as QuickBooks, UPS shipping data, Stripe data, etc., to offer a line of credit up to $100,000. I first want to commend Alan for taking so much detail and time to explain the background of fintech and all the other technology in this paper. When fintech came out of Silicon Valley really 8 years ago, it was designed and named by technologists, not bankers. And so the nomenclature around fintech hasn't always jived with traditional financial services. I think we're moving towards a confluence of the banking world and the fintech world to make some of that a little bit more understandable. And that's something that I think this report certainly achieves, and also something that Cabbage, along with the ILPA, the Innovative Lending Platform Association, is attempting to do with our Smart Box. Our Smart Box is basically a Schumer box for small business borrowers. It's a comparison and transparency tool that's really standardizing that nomenclature to create an industry lexicon for alternative finance. One other kind of reaction to this report is the assessment of technology standards is particularly important. Cabbage also has a platform business, and so we have licensed our technology to large global banks, ING, Santander, Scotiabank. We run their small business underwriting to the extent that global and national, U.S. national standards kind of need to jive in terms of API regulations, other sort of data and connectivity standards is vitally important to not only Cabbage, but the future of fintech. At the end of the day, we like to consider ourselves more of a tech-fin company than a fintech company. We are technologists offering financial insights rather than simply online lenders.
Great. Well, thanks all of you. I think, why don't we start with this question of who the regulator is and how we deal with kind of competing jurisdiction, because that seems to be one of one of the biggest things that we saw when we were talking to companies and when we were putting together this report. Even when we were putting together this event, I mean, we have two government regulators up here, but we could have had about 3 or 4 panels alone of government regulators, which kind of shows the the challenge of even making policy in this space, because you can't almost get everyone in the same room. So maybe, Brian, why don't we start with you, and then we'll open up. I mean, you're obviously working in the space a lot on behalf of financial or tech companies. How are you guys thinking about that challenge, and what direction do you want to see government moving?
It's interesting, we were talking about ahead of time. When Financial Innovation Now launched, we immediately had the task of going to see all the federal regulators here in Washington, D.C. And it just took at least a couple months to get everything calendared out and to go see everybody, just because of the logistical challenges. So it's an anecdotal way to say that it's extensive. I think every federal regulator has their role, but there is a lot of overlap. By and large, the products and services coming to market from the companies I represent all fall under the jurisdiction of the consumer protection laws, both at the federal and state level. And so you can look at primarily the Consumer Financial Protection Bureau, the Federal Trade Commission. There are others. Many of the other financial regulators are responsible for safety and soundness questions with their chartered institutions. So if it's the Office of the Comptroller of the Currency, the Federal Deposit Insurance Corporation, or the Fed, they're more involved in ensuring that a bank is managing its finances appropriately and ensuring that there's no harm to taxpayers. That's not something that we face. We're not regulated like banks because we don't hold deposits. So we are engaged with those regulators because they ultimately, I think, have an impact on the larger ecosystem. And we are engaged with many financial institutions, card networks, to bring our services to market. And that depends to a significant degree on effective collaboration. And I think what we see playing out is a fair amount of inconsistency across those financial institution regulators. And there is some downflow impact of that to our companies where we partner on specific products and services, and others in the ecosystem. So I think it would be extremely helpful to have some sort of a streamlining effort across these regulators. I know that they each have kind of their own jurisdictional prerogative and role, but wherever there's an ability, I think, at a more central place, be it Treasury or elsewhere, to coordinate that so that any kind of third-party guidance, even in that specific case, or general approaches to these questions are somewhat consistent.
Thanks. Helen, maybe we can go to you, and you can talk about how the FTC thinks about this question of both, where its jurisdiction lies, but also, how that overlaps with other agencies and when it decides, goes through that thought process of deciding where it chooses to take action versus let another agency take the lead.
Okay, well, first I will note that it's not uncommon for multiple agencies to have jurisdiction over a subject area. This is not unique to fintech. But that being said, we do coordinate. Brian mentioned the CFPB, and that's actually a great example of where we coordinate. We have a memorandum of understanding with them to make sure that we don't bring duplicative enforcement actions. And regarding the states, I know that's something that's brought up a lot, but we also coordinate with different state AG offices. For example, we had a third-party billing case against a phone carrier, and we coordinated with all 50 states to bring one action. In terms of, you asked at what point do we decide to bring an action? The test is always whether or not consumers are being harmed. We are mindful of new products and the need to innovate, so when a product is brand new, we try to start with workshops and forums to understand what's happening. An example of that is our FinTech Forum series. This past June, we did one on marketplace lending. It's a new area that I'm sure Stan's very aware of. And so we brought in different thinkers from all areas, from academic, government, and the private sector so that we can all learn. And then after that, we did a staff perspective of a blog post so that you guys know what we're thinking, and we never want to surprise anyone with an enforcement action. At the point in which we do decide to bring an action, we have made an assessment that consumers are being harmed.
Thanks. Margaret.
So the fact that the financial services marketplace is complex is not something new. And you do have a fabric of regulators with different mandates and different missions. And there are a lot of reasons for that are historical. This didn't come about necessarily by accident. When you look at the discussions during Dodd-Frank, there were quarters that wanted to significantly consolidate regulation, and Congress made a conscious decision to not do this. And I'm talking about consolidation at a federal level, as well as there were different proposals around striking different state-federal balances. And if anything, in Dodd-Frank, what you saw was that Congress kind of reaffirmed the need for multiple regulators and multiple perspectives. The coordination obviously is really important, but with multiple perspectives, what you get is a good set of checks and balances that you would lose, in sort of a unitary regulatory regime. There's enough complexity in financial services now, 5, 10, 15 years ago, that you can't have a one-size-fits-all approach. And I don't think fintech is any different in that space. The burden is definitely on regulators to coordinate and collaborate. And I think that today, in the post-Dodd-Frank era, the level of coordination at the federal level and across multiple jurisdictions is higher than it's been in a really long time. I think there were some lessons from the financial crisis that really incented people to do that. There are a lot of mechanisms. Helen mentioned, MOUs. There are structures within Dodd-Frank, within Title X, that created the Consumer Financial Protection Bureau that required the Bureau to coordinate with its fellow federal regulators as well as with the states. That's about both being comprehensive but also being efficient for regulators and being efficient for the regulated entities.
Great.
Stop there.
Well, maybe I can ask you to expand also a little bit on this question, because I think there's a few things going on. One, there's this question of coordination, which, as you point out, is something that's had to go on, I think, especially as just banks have gotten larger and cross-state, and we've kind of moved away from that purely state-based model. But there's also the question of, as the technology is coming out, we're seeing new business models, we're seeing new types of companies, right, that don't necessarily fit into these standard definitions, or we're having, slightly new services that are fulfilling existing needs, but they're delivered in a new way. So how are states thinking about those types of questions, and what kind of actions do you think states might take on the policy front in the next, maybe 3 years?
Great question. Thank you. So I think, first of all, as I mentioned before, the regulators really look at the underlying activities. And a lot of those activities fit within the bounds of existing state regulation. When you look in the payment space at a state level, A lot of the activities fit within state money transmission. Where they don't, states are being proactive, and they're looking at their rules as well as their laws, and looking for ways to modify existing regimes to accommodate these new activities, not really as a big grab for regulatory activity, but for example, in the virtual currency space, some of the way that some states had defined their money transmission laws, the definition of money excluded virtual currency. And so if you look at what North Carolina did, they sought to modify and update their virtual currency, their money transmitter laws to accommodate that. New York took a different approach, but if you look at the elements of New York's BIT license, they are not that different from existing banking and money transmission law. So states are looking at that individually. States are also engaged in terms of just talking a lot with the industry. As Brian mentioned, there are a lot of very large tech companies as well as small companies that are licensed at the state level today. One of the things that the states have done, and this is to your first sort of policy principle about supporting fintech transformation, kind of taking it in-house as regulators. There's something that the states developed a decade ago called the Nationwide Multi-State Licensing System. And that is a nationwide system that all the states use for licensing non-bank financial services providers. It is comprehensive when it comes to mortgage. And it is growing when it comes to some of these other areas. A lot of large and small traditional companies, brick and mortar companies, as well as technology companies that are providing financial services are being licensed through this. This is, again, a way to bring efficiency and to drive some consistency and uniformity across the states. The states are looking for ways to use tools like NMLS to promote and drive more uniformity, kind of organically, at the state level as they see things. And that's a big topic that the states are focused on these days. And I think that you'll see more efforts in that area.
Yeah, right. Just to respond a little bit, I definitely appreciate what the states are trying to do, Margaret, and the NMLS process, I think, while helpful, still leaves us in a situation where if you are a startup trying to do a new payment service or a digital wallet, you still have to go to 47 some odd states and get a license. You can actually go to Google's website for their Google Wallet product and look in the fine print. And there's a link to every one of the certificates that they have gone state by state to get. That process took them well over a year, almost 2 years, and that's the same timeline for a big company like Google as it is for a startup trying to get into the space. So yes, you can throw a lot of legal resources at going state by state to get those licenses, but just the time is a barrier to entry to the marketplace. And I think consistency across states with more consistency, if not total uniformity, would be extremely helpful. So I would encourage the state financial commissions and the money transmitting licensing entities to step up that process. My sense is that federal policymakers will be taking a closer look at that over the next several years and hopefully pushing that process along. We see it as a significant drag on the ability to offer an innovative and competitive service in the marketplace. And a lot of times you have a local state regulator saying, what we're doing isn't that different, just come talk to us. But just come talk to us means that 2 or more people have to actually go to the state, sit down and understand why their flavor of a particular money transmission definition is different from the state next door when the payment that somebody's making on a phone doesn't care where you are. And I think that's really undermining the fundamental idea that deserves a state-specific approach to defining money when it's really just ones and zeros.
Sam, let me bring you into the conversation. Obviously, a company like yours is all interested in scaling up, and we see a lot of companies that are smaller startups that are facing probably the same challenges that your company has gone through. What are the challenges you see in the traditional idea is you build an app and it can go global, right? And here in some of these regulated spaces, you build an app and then you have to start knocking on a lot of doors to kind of move to the next stage. But you guys have been pretty successful, so kind of walk us through the challenges that you faced and how you think other companies are dealing with this.
Sure, thank you. I have the pleasure of serving on the Atlanta FinTech Task Force, and Atlanta is Transaction Alley, if you're not familiar. So we have a lot of startups that we actually consult with that are interested in getting into the payment space. And we see that firsthand all the time, that they are discouraged by a web of federal and state regulations. Kabbage is a balance sheet lender, so we use bank partners, and those bank partners actually create the credit box, if you will, and we service that credit box with the necessary information to make an accurate credit decision. So we have been able to operate across all 50 states, but I can personally attest to the struggles of maintaining those relationships, not only from a licensing side, but just education with state legislators, education with AGs and other state regulators is a vastly complicated and resource-intensive job that truly does begin to chill innovation at some point. When we expand that into the global perspective, we look at pockets of fintech. We look at Singapore, we look at the United Kingdom, and we look at basically regulatory structures that the government has intentionally designed to allow innovation to foster with a couple of core components. Those core components mainly, it's a new and innovative product. The new product has to serve a customer need, and there's clear customer benefit that's outweighing the harm. And basically what I'm describing here is a sandbox. Kabbage, from a policy perspective, has been exploring sandboxes at a national level, whether that's through a congressional act or conversations with the OCC. The OCC's conversations are pretty interesting. They're talking about a fintech charter, and that's really a catch-all phrase right now for both the sandbox and what potentially could become a non-depository lending charter, a limited purpose charter. I think these conversations are going in the right direction in Washington, and I do commend the federal and state regulators for having these conversations and being open-minded to them. But at the end of the day, as we move into a new era of financial innovation, it's really important to update our existing banking and regulatory systems to accommodate growth and development in the technological and financial innovation world.
Thanks, Sam.
Just to cut through some of that jargon, because up here, a lot of financial stuff, it can go over your head. A limited purpose charter from the OCC, the Office of the Comptroller of the Currency, would, in theory, and it should be coming out in November, we'll see what will happen, give fintech companies the ability to be regulated at a federal level so they don't have to follow each and every state, in theory. That's what some of the people at the OCC are talking about, just to remind.
Thanks. Bobby, I want to bring you on this question as well. I mean, why do you think of Visa, it's one of those truly kind of global companies, right? And fintech is not obviously just international. What are the challenges you see, from the kind of global perspective of scaling up, the challenges that you see just kind of operating globally, and how this will continue to play out? I mean, one of the things, for example, that at ITIF we've been concerned about in the past has data localization laws, and that's been particularly targeted at payment processing.
Definitely. Thank you for the question. I guess a couple of things, just as listen to the conversation. One of the things we think about in terms of promoting innovation within the Visa ecosystem is just the power of partnerships, right? Because we're truly a technology payments platform, but we're only as good as the partners that we have. And so if you think about Visa as a network, 40+ million points of acceptance, 17,000 financial institutions who can issue, and obviously a huge cardholder base. But all that can get expanded pretty dramatically by being able to partner in new and innovative ways. And just in terms of Brian's membership, we partner very successfully with many of his members to bring new and innovative services on a global scale. But you touched on a really important point, which is that Visa, the power is in data. So for instance, I'm sure you all got a call from your financial institution at some point about a potentially fraudulent call. Well, the reason we can do that is we can, through the cloud, do a number of data analytics to say, is that a valid transaction or not? Our ability to do that is limited if we don't have access to the underlying data. And there are a number of countries outside the United States who will have requirements that you have to process domestically or process not through Visa, for instance, if it were a Visa transaction. And those diminish the consumer protection value that we can provide, because if you're not able to see all the data, then all of a sudden your ability to sort of analyze, protect, model fraud to benefit consumers can be compromised. And we notice an increasing trend on that for a variety of reasons, but that becomes a real big challenge for a company like ours, because we want to promote partnerships. We want to be able to provide services in local communities wherever our consumers sit. But unless we have the full access to data, that really compromises what we can effectively do.
One thing I'd like to add to this conversation, and since we're talking about terminology here, is RegTech. In terms of negotiating the regulatory landscape, I think RegTech is going to change how this works. So regulation technology, many people think of that as internally, how can we build our systems to be more compliant and to communicate with regulators, or at least give some sort of data output. And so, for example, Cabbage, we built our own back-end system. It's called Core with a K because we're cutesy like that. But we didn't rely on any existing third-party backbones or layer on top of architectures such as traditional financial institution would. Now, another aspect of RegTech that I think is becoming increasingly important, will become increasingly important, is the ability for regulators to issue regulations in code for certain financial institutions, technology companies, and fintech companies. Right now, when a regulation is issued, it comes to me, then I send it to the lawyers, they send it to more lawyers, we send it to external counsel, and then there's a couple more lawyers after that, and then we implement it. To the extent that a regulator, and it could be in a very specific space, it could be from the SEC, it could be from CFTC or the FTC, if they could issue code, we could implement that much quicker and frankly at a lower cost.
Sam, let me stay with you, and maybe Helen as well wants to respond to this. One of the questions that we've seen, especially in the lending space, is whether alternative lenders are covered under existing authorities, especially as regards to equal lending laws. There's this question, obviously a lot of the conversation we have is about making sure that we don't have duplicative regulation, making sure that we have coordinated activities. But there's also some concern out there that some of these laws don't cover enough, and we've seen this come up in the context of like an Airbnb or Uber Electric, new types of business models that, because of the way the company works, don't fall under these traditional definitions. At the same time, as with many of these types of new companies, they often have mechanisms in place that maybe don't require the same type of regulatory oversight. So I'll just open up to both of you. Sam, I know this isn't Cabbage's business model itself, but you work in that space. Can you tell us about how some of the companies are thinking about these types of questions?
Helen, you want to start? I'm curious. Okay. We believe that there's a regulatory web, essentially, and each regulator has a certain piece of the pie, if you will, and that frankly creates some regulatory uncertainty. Where we see that regulatory uncertainty is in the broader fintech industry, is on the platform side. And so we work with ING, Santander, Scotiabank, but it's very difficult for a large U.S. national bank to work with a fintech company because of the conflicting messages and often overlapping jurisdiction of the financial regulators and the consumer protection laws that they're just not comfortable with at this time. We believe at Cabbage that the existing laws are indeed adequate. We just don't believe that they're necessarily very clear for new entrants.
So I will start with noting that the FTC doesn't have jurisdiction over banks. But to the extent that these platforms are consumer facing, we do think that existing laws already apply. And this is probably where we disagree, because I do think that yes, these products are new, and yes, these products might not have been offered 10 years ago, but to Margaret's point, the activity is the same. If you're making a loan to a consumer, we still look at the same laws, like Section 5 in terms of deceptive representations. You can't make a representation to a consumer that's not true. Disclosure laws like Truth in Lending Act, you still have to give the consumer the adequate disclosure. And I know that there might be a lot of frustrations within the startup communities, but we do feel like, at least from the FTC, we've been very clear about consumer protection laws that already exist and they already apply. And actually, our staff perspective blog post that we issued a few months ago laid out the specific laws that we do think apply and are continue to apply.
And can you clarify, and we'll go to Morgan and Brian. You have those staff blog. I mean, one of the questions I've heard a lot is how much, a blog is a policy, basically, as opposed to something else, a more formal staff document or something that has, public input. Can you maybe clarify how should, those outside the FTC take those suggestions? Is this formal position? Is this, what exactly is that?
I mean, only the commissioners, when they take a vote on something, that's a formal position. So when one of the commissioners testify on the Hill, all that testimony is voted out. But to the extent that we do these staff perspectives, it's because we're listening to the community. We're hearing people say that, hey, sometimes the formal rulemaking process, to the extent that we do rulemaking, that's actually very limited for the FTC at this point. It takes a long time. So we want you to know what the line attorneys are thinking. The enforcement attorneys, they're the ones that come up with investigations, and they are the ones that do the litigating to the extent that the commissioners vote for them, of course. They're not binding on the commission, of course, because the commissioners didn't vote it out, but we do think that they're helpful. And I don't think that they say anything that's completely earth-shattering that industry shouldn't already know. They're more of reminders to tell people when we hear conversations about how there's confusion about what laws do and don't apply. And we're saying, here are the laws, and yes, they do apply.
Thanks. Margaret and Brian.
So Sam brought up a good point. When technology companies are partnering with banks, I actually think that the legal and regulatory framework is pretty clear because you have the Bank Service Company Act, and I don't want to dive too much into the legalese, but the financial, the prudential regulators, whether it be a state banking regulator or the Fed, FDIC, or OCC, as bank regulators are also responsible for regulating and reaching through the bank to their vendors, to their partners. And the Bank Service Company Act kind of covers that in terms of the authority that the federal regulators have. So I think that there's clarity in terms of the legal structure there. I think that there certainly is learning that regulators and the banks are doing about what these new companies might be offering. But again, if you kind of strip through the shiny stuff, it is still about partnering with the bank to provide a service to the bank. And in that context, I think it's covered. And the Bureau also has the same type of authority to get at third-party vendors. And that authority exists in state law, too.
Thank you.
Financial Innovation Now completely agrees with the perspective of Margaret and Helen on this point. In fact, we put out a paper in July detailing a very long list of, I think, nearly 24 federal and state, obviously quite every state law, but maybe in aggregate, federal and state laws that apply to any new financial product or service. And certainly for all of the consumer protection laws, whether it's fair lending or all the myriad disclosure rules, the Truth in Lending Act, that's all on the books. It's being enforced. The Consumer Financial Protection Bureau at the federal level and the FTC are out there. They're on the beat. There are numerous new enforcement actions that we've seen this year that demonstrate the Bureau's willingness to do this. The FTC is engaged as well. I think even though the companies I represent are not prudentially regulated as banks, because they're not banks, they still, if they partner with traditional financial institutions, are subject to a lot of the same kind of downflow prudential regulation because that FDIC insured bank has an examiner, multiple examiners in their offices, and they're asking these questions, and they may actually go then visit one of those partners to check out their books to find out how they're arranged. So we effectively have either de facto or call it downflow, whatever have you, the same, I think, overall regime at the federal level.
I want to shift the conversation a little bit and talk about cybersecurity, which is an issue that I think but policymakers are thinking a lot about and consumers care a lot about. Maybe we can start with you. This is obviously an issue that Navis has worked on for, I think, longer than most people have been thinking about this. How's the private sector thinking about this? Where do you think there are opportunities to improve and change?
I mean, cyber and data security are just kind of core core issues that we face every day. And, there's just an enormous amount of investment required to secure your infrastructure and to secure data. And that's always going to be a constant priority for any company who has consumer-facing data, particularly payments data, because at the end of the day, consumers want confidence that how they're going to pay is going to be seamless, it's going to be transparent to them, they're going to have protections if something were to go wrong. But another element of this is sort of trying to rethink about how we approach cybersecurity, which is to say that we're really focused at based on taking data and making it less valuable to fraudsters if they get a hold of it and include it. So, you've heard a lot about encryption or new EMV chip cards that are rolling out or tokenization, but there's a whole host of technologies that we're working to bring to market in a much more ubiquitous way to say that, look, if somehow somebody gets a hold of my information, they can't do anything with it. It's just a series of ones and zeros that are ineffective to them. And a great example, actually, and this is a great example of partnership, is all the different mobile payments that you've seen come online in recent years, whether it's Apple Pay or Samsung Pay or Android Pay. All those are powered by provisioning, where we take your card account number, we can put it on your phone, but the card number that's on your phone isn't actually your physical card number. So that number ever comes off your phone, we know immediately that it's fraud, and we can, through software, just push you a new number. So to us, that's going to be a key to sort of really solving the cyber issue. But the other thing, which comes back to collaboration, is nobody can do it alone. And it takes really the strong coordination and consultation with regulators, with industry partners, because the cyber threats are just constantly evolving.
Sam, why don't I jump back over to you? I mean, you're working with a lot of banks. This is in the things that they're thinking about. I'm guessing even when you form these kind of partnerships, there's data sharing that's going on, and there's probably going to be a lot of cybersecurity discussions. How are you guys thinking about it? And what are the challenges you're seeing?
Yeah, absolutely. It's an interesting process, actually. So when we start to partner with a bank, whether it's in the United States or abroad, we have to conform to their vendor management guidelines. And whoever the regulator is, what kind of vendor management and bank partnership regulations exist there, we do spend a fair amount of time formatting the systems to comply with that. But at the end of the day, what we have done is basically built a system of configurable cubes in terms of cybersecurity. I think what Bobby was getting at is very important. Your data is likely to be hacked at some point. What matters is if you can read that in clear. And so when we transmit data to banks and we work with banking data and they work with our data, we make sure that at data at rest, data in transit, and all the hosting points are completely tokenized, completely encrypted, and are not only conforming to kind of the public's demands, but also the regulators' demands within those vendor management guidelines. Cybersecurity is going to become an even more complicated and vital issue to the technology community. And I have to commend the regulators and policymakers in Washington for taking time to realize this and look at that. One thing I would caution against, though, is static regulations. When an agency or a legislator goes to make a ruling or a law, it's very important to look at not only what is the technology doing today, but as soon as that law or regulation is passed, what is it going to look like tomorrow? The last thing we want to do is handcuff ourselves to regulation that will be outdated the day after it's passed.
Thanks.
Just a little more point on that, which is that the consumer plays a really critical role in this too. And this is where technology innovation can empower consumers to take control over their accounts and information. So increasingly you're seeing with mobile applications, consumers being able to set constraints on how and when their data is used. So for instance, if you're thinking about a payment transaction, you can sort of set controls. I don't want any transaction over a certain amount. I want to be notified of each transaction. So if there is something that happens, they almost immediately know about it and can get it resolved. So that's another important point, in addition to all the work that we're doing to secure the data.
Margaret, maybe talk a little bit about what states are doing in this space. I think there's two interesting dimensions to the state question here. One is obviously states have an opportunity to push forward in ways that maybe the federal government isn't doing. We've seen that in the past in other areas, especially on enforcement. And the second part, though, is how do you avoid and one of the biggest challenges in cybersecurity is that you get kind of check the box compliance. And that's not a state-specific issue, but when you have these moving in that direction, the risk is that it becomes a very large compliance exercise as opposed to really actually achieving meaningful improvements in security. So how are states thinking about that? How are they thinking about that latter question especially?
Yeah, I think that's a great question. There's not an easy answer in a lot of these areas. Part of it is around, and actually cybersecurity, because that fits more into what you would consider kind of the prudential side of regulation. And so it is not an area that is currently kind of heavily subscribed. To Sam's point about, not avoiding static regulation, in the area of prudential regulation, they're looking for, the right policies and practices and controls in place, but I think that also there's a room for regulatory judgment in terms of the evaluation. So part of that also requires that you have a regulatory workforce that is up to speed. I think that's a challenge that all regulators face. I think a lot of companies face too. And one of the things that regulators are working on right now is just ensuring that, this is not an audience, and this panel is not the group where this message is directed, but making sure that the broader financial services industry is paying enough attention to cybersecurity. You have storefront entities, you have a lot of community banks, and so a lot of state regulators' focus has been on ensuring that institutions of all sizes have the right level of awareness of cybersecurity. And again, it'll sound foreign to folks like Brian's members or to Bobby's, to Visa, but making sure that cybersecurity is a C-suite level issue. It isn't just for the young kids back, in the back office, right? That it is something that boards understand, that it is core to operations and management. And it really kind of gets to safety and soundness. And so there's a lot of focus in that area by regulators, state and federal regulators. For banks, there's an entity called the Federal Financial Institutions Examination Council, FFIEC. And actually this morning has been a relatively acronym light panel in financial services. And so I don't want to introduce too many of those, but the FFIEC is where the state and federal banking regulators, as well as the Bureau and NCUA, come together to talk about examination and supervision issues. And within the past year, the FFIEC put out a cyber assessment tool for depository institutions. And it was that, and self-assessment is important here. The idea is that this is a tool that institutions, particularly smaller institutions, can do, one, without having to hire, a ton of consultants to make a first level evaluation of their own cybersecurity. And what was interesting is as soon as the FFIEC put this out, given that the target audience was banks and credit unions, you started to see other industries look at it and embrace it. I think I saw the mortgage bankers took it, and their association kind of implemented it as a training tool for their members too. And so a lot of this is about empowering your regulated institutions with the right tools, and also just kind of the constant learning too. And then the other piece is, of course, coordination. There are a lot of entities that are state and federal around cybersecurity. There's an entity called, acronym FIBIC, and I can't remember what all the letters stand for, but that is a banking infrastructure organization that does a lot of coordination and collaboration on cyber.
Great, thanks. Let me go to Helen first. Helen, the SEC has always been thinking a lot and saying they want to do more on security issues. One of the questions I have for you is, in general, how is the FTC thinking about fintech cybersecurity issues, if at all, kind of in a distinct way? But maybe within that, one of the questions that always comes up is, where do you take the enforcement action? Will it be on the technology service providers or on the actual company that's providing the service to the consumer? We've seen kind of different actions at the FTC. I was wondering if you could talk about your thoughts on that as well.
Like you mentioned, the FTC has been thinking about privacy for a very long time. We have a whole division just focused on privacy and data security. And increasingly over the past 5-10 years, there has been a lot of overlap between the two divisions. And to the point about what types of actions that we would bring and who we would bring it to, it's very fact specific, so it's hard to say without knowing what the potential enforcement action would be. But I will point to the CFPB's action against the WALA. And there is, to us, is very straightforward. The WALA made representations that they had bank grade security, and they didn't. And we're concerned about consumer information, personal identifiable information and other sensitive information. And it's even more important in the financial services area. So to the extent that companies are making representations about how their data, how consumer data is being stored, or even how it's being used, they need to make sure that those representations are truthful. And they also need to make sure that the information is being kept secure.
Maybe I can ask you Sam's question for a minute. One of the interesting things that I see is, the FTC has been so involved in privacy, and the outcome of that has been that, if you go to any website, any app, you have a privacy policy, right? And the FTC is effective because it can enforce that privacy policy. Although privacy policies sometimes contain information about security practices, it's really not the same thing. We don't really have the equivalent of a security policy for companies, and one of the outcomes of that is that as a privacy conscious consumer, I can decide to use this service or that service depending on what the company says, and I know the FTC will enforce that. Should we be looking for something like that in the security space, where we can make see more transparency from companies about what their security practices are, have the FTC hold them accountable and provide more information to consumers?
I think more information for consumers and more transparency is always a good thing. Obviously, we can't mandate what companies decide to do, but like privacy policies, to the extent that they make representations, we will assume consumers are relying on it.
Right.
Well, I just wanted to go back to a little bit of what Bobby was saying. One of the challenges that we face in talking about mobile payments or any of these kind of security issues is that there's sometimes among policymakers, but even among consumers, a perception that because it's new, that it's less secure because it's untested. But in reality, the level of security that you have on a mobile device is, and I don't want to sound like I'm exaggerating this, but it's exponentially stronger than you would have in a typical kind of traditional banking environment. You have all kinds of biometric authentication measures available to you beyond just the fingerprint that we know about. If you think about the IoT and voice recognition, there's going to be a level of authentication occurring there with your voice. Financial institutions are taking advantage of that already. So I think the important thing that people ought to focus on when you think about cyber is that the technology itself is creating new and better solutions to enable that. And going back to actually what Bobby was saying about the cloud, what we've found is that oftentimes regulators are looking for, believe it or not, they want to actually go, where's the drive that I can pull out and take back to headquarters and examine? And this is a little bit more of a kind of a law enforcement forensic type of analysis, but it really doesn't have any concept of the way the cloud works. If law enforcement needs access to certain information with a lawful request, they can go get that. And that is actually more effective and allows them more tools to get what they need to conduct the, in whatever enforcement action they're involved in. And I would say that, the interesting thing, Helen pointed out the Dwala example, that I think put a lot of people on alert because it was the first enforcement by the Bureau of a quote unquote fintech company. And it was a case where there was no consumer harm. A company, according to the Bureau, misrepresented the degree to which its security was good. And I actually am not exactly sure how the Bureau went about assessing that Dwala's security was not bank grade. Interestingly, you see companies trying to say we have bank grade security. Oftentimes, I would be hopeful that they would say we have Google or Amazon grade security, because these are security companies themselves. The federal government actually comes to companies like Google and Google and Amazon for secure IT. The CIA is on AWS. So I think that there's an evolving sense of what constitutes security. And to Margaret's point, which is solid, having regulators understand how this is constantly evolving almost week by week is really, really critical.
Great. So I want to open it up to audience questions, but before we do that, I want to spend a few minutes on this last question of what Congress and the next administration should be thinking about in the fintech space. And there's two dimensions to that question. One, what should they be thinking about in terms of accelerating kind of innovation and adoption, just generally in the private sector, but also within government. I mean, there's a lot of payment services as well as financial service activity happening within the government, where government can be an early adopter. Why don't we just go down the line and we can start, Bobby, on what should government be doing? What should the new administration do? Maybe it's first 180 days.
So just a couple of thoughts. One, the report actually did a nice job of talking about encouraging government to be an early adopter of new technology solutions. And there's some great examples that they cite. The one that we've been working on a little bit in recent months is with Singapore. The government has sort of created a universal app for consumers in Singapore to get access to services from the multiple different government entities all through one interface, right? And so the consumer experience becomes really critically important. And so government as an innovator is an important topic. The other thing just to think about, we haven't talked much about Congress, but just picking up on our last conversation about security, anybody who's followed the data security conversation knows that's been an issue for the Congress for at least the last 11, 12 years or so. One of the reasons that it's not been able to get anywhere is because of just jurisdictional issues. One committee will take it, another committee will have a different view, and ultimately you have 6 or 7 different committees who are involved, and a consensus is not able to emerge. So, as we think about collaboration, it's also important for members of Congress and committees to think about, okay, what's our policy objective and how can we achieve it? Because in some of these things, there's actually a pretty good consensus about the broad policy we want to achieve, but some of the details get obviously specific depending on what industry sector you sit in. So I just think as we talk about collaboration and sort of driving policy discussions, it's not something that's just unique to the regulatory environment, but Congress needs to take a look at that as well.
So, Congress has multiple roles, not just as a body that passes laws, but as an oversight body. And I think that Congress will and should be using its oversight responsibility to really think through a lot of these issues. There's been and Brian mentioned the idea of a federal charter, and I think that also Alan talked about that too. It's not clear to me and to the entities that I represent that the policy consequences have really been fully thought out, and so I'm looking to, and we'll be looking to policymakers to think through that, because when you talk about federalizing something, a sector of the economy, that's kind of the exception, not the rule in the economy, where it's not as if in other industries you have federal business licenses and federal authorizations to operate. And so when you think about drawing that kind of connection, to the government, to the taxpayer, to the payment systems, there are a lot of consequences. There are upside benefits, which the report does talk about a lot, but there are a lot of downside risks that haven't been fully thought through in terms of risk to, like I said, payment system and taxpayer. There are also risks to the consumer. One of the things that's not clear in terms of the platform lenders and some of the marketplace lenders is how those entities will operate through all parts of the credit cycle. That's something that's been talked about a lot, but I think that I think time will tell on that because you do have kind of a grow fast, fail fast mentality in sectors of technology, and that's how you have innovation. And it's great for people to take risks, but it's sort of the downside consequences of those risks and how those knock-on effects could affect the stability of the marketplace. And so I think there's a really robust discussion to be had at a lot of different levels.
We don't have a specific legislative recommendation at the moment, but I would agree with the other panelists that oversight is effective, and we have seen a little bit of that already coming from the Hill. We actually hope to see more of that. That can go a couple of different ways, and I think you can over-rotate on kind of ensuring regulatory parity and closing misperceived gaps. But on the other hand, it can also, I think, strengthen some of that regulatory coordination that we were talking about. I think it would be helpful for Congress and the administration to work together to provide some of that leadership on the administrative side. I know one company recently suggested that the next president have a fintech advisor. That's creative thinking, and we're going to be encouraging that kind of thought going forward.
I agree with other panelists. I think that it's important for policymakers to have an oversight role to fill in any gaps that individual agencies don't might necessarily see in their own roles. And I will note that I do think that consumer protection and innovation go hand in hand. I know that people think that there's tension between the two, but from our perspective, we think that if consumers can trust a product, they're more likely to use it, and that's something that different fintech companies can actually compete on by offering better consumer protections than other companies.
I completely agree with Brian on his coordination point. I think I'm a long way off from my national charter or sandbox. And before we get there, frankly, there are a lot of things that have to be done. Congress, first and foremost, needs much more education on this topic. I was having a conversation with a staff member, and we use artificial intelligence in our technology, and the first thing that came to his mind was Skynet, not Siri. And that should be something that we need to work on. But government APIs and data access too, that's an easy win for everyone, for fintech companies, for banks, for consumers. If we could open up an IRS API so you could port your tax data to a Mint or a Cabbage to underwrite a small business loan. And then finally, starting a much more in-depth conversation about data portability and data access. There was a time when if you were on Verizon and you wanted to change to AT&T, you couldn't port your number. We want to have an environment where when you move from B of A to SunTrust, or you move SunTrust data to Cabbage, that's an easy and simple process for the small business customer or the consumer.
Great. Thanks. So I want to open up the audience question again. Anyone who's watching online and wants to submit a question, you can do so using the hashtag #ITIFFintech. We have a question right here on the left.
Hello, Chris. My name is Chris Robb. I'm from Severs Holdings, founder of a fintech startup as well. Firstly, I just want one question for the industry and one for the regulators. Advocation of a national charter. I don't think that's realistic, and I think you can wait all you want. It's just not going to happen. And if it did happen, I would really be careful what you wish for, because you got to remember the social governance difference between a charter and a license. What most fintech companies need just by the basis of their business model is a license, and the existing state framework seems to provide even a better sandbox than any centralized federalized charter would. I think generally it's been found that fintech companies who embrace compliance are generally more successful. I mean, if you look at the peer-to-peer guys, as Margaret pointed out astutely, they've never been tested in anything but a Goldilocks credit cycle, and their loan losses are already starting to elevate. Now, I think this is a perfect example of a problem with them not being subject to federal regulations. If they were subject to QRM, they would be a lot better prepared for a credit crisis, because they would actually have a stake in the fee-based origination model they have, rather than just being driven by volume. So, I mean, and I don't mean to prove the argument. There's definitely some legitimacy to it, and it would be great if a good one could be created. But I just, from my experience, I just doubt that the federal agencies are going to come up with something that's going to be any better than the state system already is.
Okay, why don't we go ahead and respond? Whoever wants to respond.
I mostly agree with you. These conversations are ongoing, and certainly the charter has not been, or the sandbox for that matter, has not been fully fleshed out. It's an interesting conversation that we're willing to participate in and see where that goes. It's not my primary government relations objective. It is something, though, that we're going to stay involved with and continue to have that conversation. And that may not necessarily lead to a charter. It could lead to some other sort of licensing structure. It could lead to much more informed conversations with state regulators. I don't know where it's going, but we're interested to be a part of it.
It's important to note that the OCC's limited purpose charter won't be a full charter. It'll probably be very limited. We won't know exactly what it is until they come out with it in November. Now, it is important to create a national set of rules for many of these things. As Margaret astutely pointed out, NMLS helped the states create a single kind of framework around mortgages, but that doesn't exist in other things. It doesn't exist in payments, it doesn't exist in insurance, and especially in insurance, we see a huge barrier to entry for startup companies. There are only a handful of them taking off in this country. So being more friendly to new applications, learning more about what's going on in these different economic sectors, it's going to help kind of promote more innovation in different services.
The NMLS didn't change any state law or jurisdiction, it just consolidated the database.
Yes.
Right here on the left.
Good morning, everyone. My name is Mauro Mora. I'm an MSc candidate in digital innovation from the London School of Economics. I have a question regarding something that we have not talked yet. It's about access. How do you think financial technology and services will help reducing poverty, taking into account that we have more than 4 billion people living under US $2? So what's the role of financial technology and what should policymakers do about it? Thank you.
I'll take that. So we see an enormous role for this. The challenges for most financial services, whether it's access to capital or access to the payment system, the ability to move your money really is all about access and control. And when you have essentially everything at your fingertips or at your voice, your beck and call, that changes things because you're not beholden anymore to the hours or the location of a bank branch. You are able to essentially move money at the speed of the internet, and that's significant because I think when the financially underserved are living paycheck to paycheck, making sure that you pay a bill on time if it's your landlord or put food on the table means that you have to have access to your money right away. If you don't, you turn unfortunately to alternative financial service providers. So you're going to go to a check cashing service where you pay 1 to 5% of your check to actually get access to that cash. Then you're going to do a cashier's check or something like that to pay a specific bill, or you go to a payday lender or a title loan. These cost a significant amount of money. The research shows that I think for the average underbanked household in the United States, they're making about $22,000 a year. They spend $1,000 of that income just to manage their money. So that's an enormous imposition on essentially people who need financial services the most. What technology can do to change that is actually give consumers access to their money when they get it. So it's not stuck between financial institutions while it's clearing. You can move money faster. It's helping them get access to credit more quickly, effectively, if they need it at a lower affordable rate because of the scale and the efficiencies that you have brought by these technology platforms. So we think there's a tremendous opportunity here. People have been talking about the challenge of the unbanked and underbanked for a long time. The true change we have now is that this is all in your pockets. It's easy, it's accessible, and it's always there.
Let me just maybe add on to that because Visa's doing a lot of work in this area globally. And just reference, we partnered with World Bank and announced an initiative where we're going to bring 500 million consumers into the financial system who previously were unbanked globally. And, technology is just a change maker here because if you think about a map of the globe at night, right, there's certain areas of the map that are lit up. And all those places traditionally work with payment cards, right? But if you're sitting in Africa where there's no electricity, this doesn't work very well. But the one thing that consumers have in Africa is ubiquity of mobile devices. And I'm not even talking smartphones. These are just feature phones, right? Flip phones where I can actually pay you but just by texting dollars. So Visa's actually launched a number of services, but the thing that makes it work is that you also have to think about disbursements of benefits for consumers. And so working with governments to sort of easily get consumers access to their funds quickly. We did some pilot programs in Rwanda about this, which actually helped deliver disbursements to consumers instantaneously, and they could go out and actually buy food for their families. They could transact commerce in much more efficient ways. So this is an area where there's just rapid transformation, all because of the technology, which previously wasn't, didn't enable that. But I think over a period of the next 5-10 years, you're going to see a rapid transformation in terms of access for consumers. And governments actually are taking a really proactive role in, moving payments from check or from other forms to electronic just because there's so much more efficient delivery. And that's helpful for the government because the government has a good sense of, hey, I'm actually getting the money to the person who needs it, reduces waste, fraud, and abuse as well. So it's a great question, and I think there's a ton of stuff happening. And by the way, this isn't just outside the United States. There's a number of programs within the United States that are happening too, which are important.
Other questions?
Hey, how you doing? My name is Ben Yorkman. I work with Village Capital. We work with early stage entrepreneurs, and we are putting on a forum around the future of work and kind of the 1099 worker and the millennial sort of. I'm curious about how you see financial regulation impacting sort of student debt and the issues that a lot of other people are coming out in the 1099 workforce, as well as going forward with underserved workers, in some of the veins of how policy is affecting that landscape. Could you talk a little bit about regulation affecting portable benefits and some of those issues? Thank you.
I'll take this. Financial innovation now really doesn't have a lot of specific policy positions, or we're not going to do a lot of work in that area. I do know that Intuit, given their user base, they have a large number of small businesses on their QuickBooks platform. They've done a lot of research. I point to a report or two, I believe, that they've done. I can follow up with you afterwards, where they do grapple with some of this. And I think Intuit's approach is how do we help these gig workers manage their compliance, so to speak, with tax and all the other kind of traditional things that you have to do as an employer. But in this case, your own kind of proprietorship or your own work benefit. The interesting thing, I think, from the fintech discussion that you see just, I think, 2 weeks ago, Lyft announced that they were doing instant payments to their driver partners. It's interesting that they just chose to do that. I think I would ask people to kind of look at, well, why does that matter? Why is it important? The nature of the work that people are doing for a company like Lyft is kind of very much on-demand work. And in some cases, you're doing on-demand work because you demand funds now. And that is apparently a significant benefit that their driver partners were very interested in, and the uptake is significant. I believe I think they were given an option. And I think in a very short period of time, half of their partners were doing that. So again, it goes back to speed. People need access to funds. They need to be able to move money. They need to be able to know that the funds are going to be there and available in order to pay for whatever need they have. In some cases, it might be because they're going on vacation, but maybe because they need to put food on the table.
Just also in response to your question, one thing to highlight is Senator Mark Warner of Virginia has really taken a look at this issue in terms of portability of benefits as you think about the sharing economy and how workers are going to just move around and have a lot more jobs than they ever did before. How do you service them, whether it's in the healthcare context, whether it's other benefits. And then just to pick up on Brian's point that, the ability to just disperse funds quickly, disperse payments. We often think of payments as, I pay you because I, owe you money. But in the context of the sharing economy, it's really important for the service provider to get paid quickly. And so Visa has a number of services that allow them to get the benefit of their funds immediately. They're good for use going forward. So this is an area, I think, a lot of transformation, certainly much more is happening, but it certainly is on the radar screen of policymakers to think about how do you sort of think about this concept of a portable workforce when we haven't really done that before. It's always been very stable employer-based benefits previously.
And the report highlights a number of different areas where small businesses can benefit. And we talk about faster payment transactions. We talk about invoice finance, which is something that can really help businesses ease the burdens of their supply chains, get cash quickly for minimal payments. And we talk about how some of the new services like Cabbage for lending actually can tap directly into people's kind of like workbooks and the employee data to give better rates to people directly using their own information. They can judge risks associated with each business and so forth. So really it gets down to how regulators can help this innovation forward while still protecting consumers. And I think the panel did pretty well talking about that.
Well, with that, we're going to end the panel. I just want to do a quick plug. Tomorrow we have an event, Data Innovation Day. algorithms, automation, and public policy, where we dig into kind of broader questions of artificial intelligence, machine learning. If you're interested in that, you're welcome to sign up. It's on the ITAC website. Please join me in thanking our excellent panel.